Good day and welcome, guys. And on today's mentorship, I will be talking about and doing a breakdown on the order flow. Order flow is a term we use in the market that describes the flow of the market, whether it's going up, down, whether it's going up, right? It is the order flow. Orders are very bearish, in a downtrend, and that's how the market is essentially flowing, right? So today's breakdown is that show you how I understand the order flow and how I look to understand the order flow before I can place a trade, right? So I'm going to be speaking in three different terms, right? I'm going to be using the word POI, which is an abbreviation for point of interest. I am going to be using the word pro order flow, which means going with the trend, right? And I'm going to be talking also about liquidity sweeps. With that being said, that should make you understand that within the market we have order flow and we have liquidity and we have supply and demand zones. Whether we take trends at fair value gaps or whether we take trades at lower time frame supply or demand zones, right? What matters is that we are taking trades that are in line with the market, right? And it's the same thing. If we are in a bullish market, we should expect, or I should expect, to take buys more than sells, right? It is inevitable that the market will eventually sell in a bullish market, right? As well as in a sell market, it is inevitable. It is in due time that the market will start to buy, but we should be looking for mostly trades that fall in line with the higher time frame order flow. In a real life market, the market would tend to move, right, reach a point of interest, and then start selling, right? We mitigate and break away from this previous low, moving lower, either consolidating, right, or moving up to fill out an order block or fair value gap, anything that would cause the market to come back and act as liquidity before going to the downside, right? We might experience that, and the market moves below, and that seems to be the case for most of how the market is. You understand? It won't be as clean as it looks on an illustration, on a breakdown, but understand that what matters is that there are lows being broken every time the market is going down, right? And that's how we know that the order flow is bearish. So we all understand that at this point, it is clear that we understand where the market is going, but what comes next is where would it be likely a good area to trade, and then look for entries. So as I said, the market, before the market sold out, it was bullish, and we eventually caught onto a higher time frame point of interest. It can be a PD array, right? But that's a different story for a different day. But for this lecture, I could say that, you understand, we might have mitigated a fair value gap, right? The second point of interest that would likely hold is that if we mitigate an order block, right? These are the two point of interest, the two market structures that can be classified as strong enough to hold the market when we are looking to take trades that are counter trend to the current trade, right? So if this is the current trend of this market, looking for a fair value gap or order block would be a nice structure or entry area to look for trades that do a counter reversal for the market that eventually falls in line with the overall narrative of the market. So understanding that is that we either look for an order block or fair value gap of the market. We move in line with the order block, right? But we have to understand that with structures that we need to see when we want to understand how valid is an order block, you have to understand that within order flow, right? Within order flow, the market moves in its own way, breaking lows and highs, right? So, looking at this, if we want to take a sell, trade, going bearish, since the overall order flow is bearish, right? We have to understand that lows have to get broken first so that we confirm that the market is bearish, right? So once we get a break of structure to the downside, we have to anticipate which order block would likely hold, right? There can be a possibility of an order block here for this example. I would say that if the market has an order block here and we also have an order block here, which order block would likely hold, and how do I know that the order block that I pick is correctly? So I'm going to break it down into a few criterias. Okay, the first criteria of validating an order block is that there needs to be no liquidity that is sitting above an order block, right? An order block has to sit above liquidity always, 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 right? These order blocks might hold and they might move, they might hold and they might eventually go in the negative side, getting your stop loss taken out. You understand? So having a criteria of always waiting for the market to mitigate any liquidity that is sitting below here, right? Liquidity that is sitting over here can be a fair value gap, right? Any imbalance that needs to be mitigated, right? It can also be an order block here, but understanding that if there is a structure that can be filled, a fair value gap that can be filled, can potentially draw price to move within this direction and get you in the wrong side of the market, right? Because if the market can buy and then retest this old order block, you would likely look for buys and confirm that no, since the market didn't break this low and it only rejected higher, we could be in a bearish market. When the simplest explanation of this is that the market is actually coming to retest the higher order block so that we can look at structure and start selling to eventually break sell side liquidity, right? So the rule is that an order block has to always be above liquidity, and the higher the time frame, the stronger the order block, right? If we have a 1 minute order block, we have to go at least one time frame higher to analyze and assess what are the chances of it holding, right? A good order block is when we have multiple order blocks on the same position in the chart, right? So if this is a 1 minute chart, if I go to the 15-minute, I should be likely to see an order block within this range, validating that, for the time frame that I'm trading, I know it's stronger because the market has actually mitigated over here, and we can get a good setup from this, right? But understanding that but understanding that we need to have liquidity that is sitting below the order block puts us in a position to be ready. Puts us in a position to be ready. And as you can see, liquidity can also be classified as buy side liquidity, right? Two types of liquidity that I'm going to be breaking down in this video is that we have liquidity that is within candlesticks, and we have structural liquidity. What does that mean? It means that we always have a high and a low, and above the high we have liquidity, or below the low, or on the low exactly specifically we have liquidity, right? So understanding those two narratives can tell us that if the market is having a liquidity standpoint below an order block, right, there is a chance that the market might invalidate that liquidity so that it mitigates an order block and end up moving with the overall flow of character, right? So that's what the importance of understanding the overall trend of the market is, so that when we take trades, we are pro order flow and take trades that are in line with the overall trend, right? So once you take a trade like this, it does not matter where you put your take profit, because eventually the market will get there, right? But my overall target for taking such trades is to put my take profit at the previous low, because if the market breaks this low, I know that the market is indeed bearish, and I can expect the market to be bearish until any significant high can be broken within the next cycle. So now we are about to do a actual chart breakdown of the market. This is a very limited image, but I am going to do a live market since today is Monday and the market is open. I'm going to go to the real chart where I actually took this entry right here, and we will get to see how far did it go or how did it play out, so that you can try to take the lessons that I put into a good understanding within a market. Because as you can see, I am saying here that the market is bullish. However, the way the market moved may not be straightforward like the lectures and the lines I drew, right? The market would move on its own, and we would have events and unexpected things that can make the market move in unexpected ways. So, with that being said, what I want to do now is give you a point where we can understand where it all started, right? So, zooming into this current time frame that we are at, it's a 15-minute time frame, and this was on the 7th, which was yesterday, which was Sunday the 7th, and the screenshot was on a 15-minute time frame. And I took this screenshot after my midweek review and trying to create a weekly bias as to where the market would likely go. Hence, I found this entry using the order flow that I've already put in place. But ignoring this Fibonacci, it's a whole other strategy that is also based in the understanding of order flow, right? Any strategy works. Any strategy has the potential to not work. But a strategy works when you understand the market, the direction of the market, right? Once you understand the order flow, where the market is going, then your strategy does have a chance of being a winning strategy, right? So this was to determine if I am still in line with the order flow, and if my bias and my entry criteria was top tier, right? So zoomed in on a time frame like this, it is quite clear that the market has been consolidating bearishly, right? It has been selling off, but at the same time, it's been corrective. So speculations here would be a lot. There would be a lot of speculations to find the bottom and to try and buy, to find another bottom, which was over here, and try to buy off of it again. So speculations in a very corrective market would be a lot. You understand? Because I also took a buy here, which ended up taking me to small profits and then down my stop loss, right? However, if we have the chance to zoom out and look at a macro time frame, right, we will realize that below we have structures that the market has targets onto, right? There's a specific price, right? And the market will always target price before targeting the next price, right? So this was Friday. Yes, this was Friday and this was 6 a.m. So this whole day has been Friday. See, this was Asia. So this was the Asian high. So after Asia, basically we stepped into the London session consolidating, right? There was not much movement. And that could be a valid reason for that, since this week was that week, last week was NFP week. So Friday was the first NFP for the first month of the year. So, right, we got consolidations for that year. So, looking at that, we can understand that, okay, since the market generally moves in the opposite direction before the overall one, what is most likely to happen if the market could fake out? Where would the market likely go, right? If we have a support or if we have a supply zone and a demand zone, if the market fails, where would it likely go before the market goes in the correct order flow, right? So we know that the market is already bullish, right? The market is already bullish. It has been bullish in the past, but now this consolidation is taking the market somewhere. And the goal is to find out where would the market likely go if we have supply zones that fail, right? So I'm gonna step into the chart now and actually come back to this, right? And here we are. Okay, this is the current market now. So it is clear that the market is bullish, right? We have been breaking highs all the time, and we broke this major high. During this week that happened over here, we can understand that where the price was tapping, it's where the market previously made an order block. So understanding that the market actually went into an order block during the NFP stipulates that only the market only came within this structure so that it can mitigate price, right? It can mitigate the overall orders that was sitting below these order blocks, right? So the high time frame order block, which was the 1 hour order block, was more stronger than these inner time frame structures, right? And we switched back to bullish, right? The fact that the market did not have any closure below here, we do not have any candlesticks that close below these lows over here, says that this fake out indeed went into an order block to retest what was already happening, right? So in a normal market, if the market would have went into an order block, right, what we would have seen is that if it was not fundamentals, the market would have came within this order block with candlesticks, right? Even if the market came in the order block within candlestick, but the fact that we know that the trend is bullish, right? The anticipation for a reversal is inevitable because now the market is in line with the trend. Okay, so hence This is what I use. And with implementing liquidity that is sitting above a bullish order block, right? In a bearish order block, we know that the liquidity sits below, right? So that was the case with this trade. We had a sell side liquidity that the market mitigated into an order block, making this a very valid trade. And I took this trade during NFP. I just went into here and then I closed my profits just above 60 pips. And yeah, okay. Now that we are within order flow, my second entry was based off of the same concept, right? It was already clear that the market was bullish, right? And when we start seeing a consolidation, the second step is to look at where would the market likely seek liquidity, right? So stepping out of that and coming within here. So looking at this live market example, this is exactly what I have replicated, right? So the market is still the same, okay? We are pro order flow, okay? The market has been breaking highs all the time. So we know that the order flow is bullish, right? The more highs that the market breaks is the probability of the market being bullish. All right, guys, so coming off to the end of this lecture, I just want to give you guys a few tips. You understand? Most of the content that I've watched, the person that makes the video or the mentor, they always make end of video tips on what to look at and how to look at it. So this video that I made is if you are struggling to understand the market and where price is going, right? And the overall space of the smart money concept, right? This is the first leg of what is going to be happening. And as I've told you, part of the plans of releasing future content that is more of lessons as to how I personally trade. And if this is a strategy that you want to use and want to use it as how I use, you can kind of use it as a reference to understand how I look at it and how I talk using the smart money concepts. Okay. So what I would advise you is that make sure that as you're watching the video, take as many notes as possible, right? Always take notes. I would take this video as mentorship for me to understand the basics of liquidity and the smart money trends. You understand? So make sure you take notes and you actually watch the video to understand the market, not for just entertainment purposes only. Make sure that you have taken notes and taken this video as seriously as enough. This might be just educational content, but if you are serious about trading Forex and trading the market, right, take it as serious as you can so that it has an effect on your trading journey and actually benefiting you in the long run. You understand? And if you don't have a journal, one thing I do definitely have is my Notion template. So if we were to go here, this is where I usually journal every trade, right? Make sure that if you have a trade that you plan out and trade using the order flow, make sure that you have a journal that you can use to journal your trades, right? So this is the journal that I use. It's on a platform called Notion, and everything that you see here, I have created myself. After using so many journals, even this book that I have has been a journal, and this is what I use to keep up with the market and myself so that I become as consistent as possible and as formal as possible. Because as you can see, my slogan is to be always one step ahead. You understand? Always be one step ahead of myself and the market so that I do not overreact. I remain patient and I remain with a strategy of plan, like always. Understand? So those have been my tips. And if you have been watching up until so far, again, thank you so much and I appreciate it. Thank you for being a part of my journey to becoming a successful Forex trader. This is a new year, and this is the year that I am trying to make it happen. And thanks for watching, guys. Make sure you like and subscribe for the next video.